intervention might just stave off a 1930s-style collapse. It might. Interestingly, though, the system is in such disrepair at the current time that nobody, not George Bush, not Barack Obama, not Stephen Harper, not Stéphane Dion, is claiming that state intervention could do much more than prevent total collapse. Nobody seems to know how to pull our economic system out of this mess. In short, it seems that nobody's quite sure how we can begin to stand on our own 2 feet. But such government intervention will result in huge levels of public debt at a time when the U.S. budget deficit is tipped to rise above $1 trillion. This deficit, combined with high interest rates and low rates of investment, could lead to an extended period of negative or low growth. A similar pattern gripped Japan through the 1990s. Nevertheless, the crisis has set off a debate that's permeated down from the boardrooms and treasury committees right into everyday conversation. People ask, is this crisis over? Was it the result of a few rogue bankers? Is the world economy fundamentally sound, as Stephen Harper and John McCain proclaim? Could more regulation of financial markets stop the chaos? Or is this crisis actually rooted in something more fundamental, the failure of the free market and capitalism itself? That's a conclusion that our rulers do not want us to reach. But it's precisely the conclusion I think we should draw. Now, what lies behind the current crisis in the banking system? Let's examine the more recent events that started this mess, and then afterwards we'll go a little bit deeper into some of the problems that led to it. In the U.S., there's a subprime mortgage market. Subprime meaning people with low or insecure homes, or insecure incomes, and people who had usually been refused credit in the past. When this subprime mortgage market collapsed, it began what's now known as the credit crunch. This market developed as different lenders scrambled to find new targets to sell their mortgages to. They made loans available to people with low credit ratings or on low incomes at extortionate rates of interest. There's even an extreme version of this called a ninja mortgage. And every time I think of this, I actually think of my cat. My cat's named Ninja. Although the comparison's a little bit unfair, because he's the sort of predator to catch bugs around the house. He's not the sort of predator to cause a global economic crisis in the interest of maximizing short-term profit. So what does NINJA stand for in this context? No income, no job or assets. You don't make any money? You don't have any money? Want a house? Sign right here by the X. You know, this would be great if it were actually about fulfilling demand for housing for those who can't afford it, but it's not. It's about maximizing profits at the expense of the poor and vulnerable. This meant people took on a level of debt that was impossible to manage. The market began to unravel as it became clear that people could not afford to repay these levels of debt, just like throughout the 20th century and beyond, where people in what's called the third world couldn't afford to repay the debts that had been incurred by their governments. But the bad debts did not simply affect the lenders who issued the mortgages. No, they actually spread throughout the world financial system because of a secondary mortgage, or a secondary market in mortgage debt. Mortgage debts were repackaged into bonds that were bought and sold by other institutions. Anyone familiar with the casinos known as stock markets on Wall Street or on Toronto's Bay Street knows that traders and banks made a lot of money in the past few years speculating on the value of these bonds. When people began to default on their mortgages last year, it became very clear that these bonds were far riskier in investment than many had previously believed. It's a little bit like discovering the hard way that the house has a statistical advantage on the roulette wheel after winning big a few times. But because of the way that the debts had been repackaged and sold on, no one was quite sure where the bad debts had ended up or how big they were. And we still don't know. Banks stopped lending to each other out of fear that they wouldn't get their money back. This created the credit crunch, when the credit between banks that had been easy to come by suddenly dried up. A good way to describe this credit crunch is to use the analogy of a heart attack. The entire capitalist system depends on borrowing and lending money. Manufacturers lend money to wholesalers. Wholesalers give credit to the retailers they supply. And of course, retailers give credit to consumers to encourage us to buy things. And of course, on top of all this, banks borrow and lend money to each other in the form of short-term loans in the course of their everyday business. Economists call the way that money and commodities flow through the market in this manner liquidity. And it's a good way to think of it, especially if you think of it as a kind of lifeblood necessary to sustain the economy. If there's a major blockage, like this credit crunch, then the economy basically has something one could compare to a heart attack. Some, such as the huge British bank Northern Rock, relied very heavily on this short-term borrowing to finance their business, rather than using the traditional means of deposits in customer savings accounts. When the lending stopped, Northern Rock was plunged into disaster. The British government stepped in to nationalize it. Speculations fueled the crisis. As investors and traders lose confidence in their bets, they move their money elsewhere, creating panic among others who then followed suit. Now, is this crisis all the fault of speculators? As the banks have crumbled, we've seen cases of people making millions of dollars from the collapse of these companies. They did this through short selling. This is a really bizarre practice. Traders, often working for very secretive financial groups called hedge funds, take shares on loan for a given period of time. They then sell them immediately in the hope that the price will drop and buy them back at a later date. Hopefully at a lower price so that they can pocket the difference. Even in the gambling dens of the stock market, this is frowned upon. So various governments around the world have banned this practice for certain stocks and for a short time. Interestingly, as recently as September 7th, economic regulators issued a press release pushing heavily for a removal on restrictions of short selling here in Canada. September 7th. Due to the massive failures in world markets just a week later, temporary orders banning the practice were issued. The prophets certainly have the gift of foresight, don't they? As the revolutionary socialist Karl Marx once put it, the financial system is one of the most effective vehicles of crises and swindle. For instance, insider dealing is illegal. But knowing in advance that a company is going to announce something, knowing whether that news is good or bad, and so knowing whether to buy or sell shares is highly lucrative. One study of 172 mergers on the U.S. stock exchange found that insider dealing took place in every single case. I'm reminded a bit of the Wall Street Journal. They have a regular column, and it's called Investment Dartboard. While those on the inside have this kind of knowledge, they can use the accuracy it provides to their own ends to make obscene amounts of money. While the rest of us, should we have the means to actually gamble our money in this system, or if our retirements or pensions are tied up in it, are at best throwing darts at a dartboard covered with the financial pages, or at worst playing the blindfolded game of pin the tail on the donkey.